At this point, you should have completed the core case in TaxSlayer and compared your work to the answer key. If so, then it's time for a review. On the taxpayer's copy of the tax return, TaxSlayer has masked the Social Security number of both the taxpayer and the spouse. That's not a problem because both of them have SSA 1099s, and those have the Social Security numbers you need. But it's more of a problem for the dependent because there is no SSA 1099. So you're going to need some other source of information from the taxpayer for the SSN or I-10 of the dependent. Speaking of the dependent, we see that the dependent got credit for other dependents. That's $500 in 2020. We should expect something similar in 2021. The taxpayer has interest in dividends, has a significant amount of pensions and annuities, some of which is not taxable. Social Security, the taxable amount is 85% of the total benefits. That's the maximum that is possible because in this case, there was significant amounts of non-Social Security income pushing the tax rate to 85%. And the last interesting thing on page 1 is that there's a capital loss of $3,000. $3,000 is the maximum amount that's allowable as a loss on a tax return. If there's anything more than that, it has to be carried forward into the next year or years. And so we would look for a capital loss carry forward because it's very unlikely that there was a loss of exactly $3,000. On page 2, we can see that the taxpayer itemized in 2020 because this is not an even number, a rounded number. That would be the case if this were a standard deduction, and if you know anything about standard deductions, this is way higher than the standard deduction. Here's the credit for other dependents, $500, and we have withholding on 1099s of $4,800, which is more than the tax owed of $3,488, so we would expect the taxpayer to get a refund. Since we saw the itemization, we expect to see a Schedule A, and here it is as we scroll down. So there's high medical in 2020, way more than the 7.5% threshold of 6156. There are the taxpayer in line 5A, the box is checked. This checkbox is critical in determining whether a state tax refund potentially is taxable or not. So let's read this carefully. If you elect to include general sales tax instead of income taxes, check this box. Box 5A can be built to you around general sales tax. There's a calculation process for that. Or the actual state income, California state income taxes that were paid during 2020. The taxpayer thought that it would benefit more by using general sales tax. What this means is that if they overpaid their California state income tax, if they got a refund, that overpayment was of no benefit. They didn't use the amount of state sales tax paid on their 2020 tax return, so they got no benefit from overpayment. That overpayment results in a refund. The refund results in a California state tax document, which can be ignored. If this box were not checked, if they'd used state income taxes, then we'd have to consider that refund as potentially taxable and go through a process of determining how much, if any, was income and would go on the tax return for 2021. But again, because this box is checked, the California state tax refund is not taxable and can be ignored. We have some real estate taxes. The total tax of $9,293 is under the maximum of $10,000 allowable for state and local taxes, sometimes referred to as SALT. So all of this gets carried over to the right column to be used. Line 5C is worth noting that $132 is almost certainly vehicle license fees. This looks pretty good because unless the taxpayer and spouse just have one vehicle, this looks like it's just the VLF portion of registration fees. One of the common mistakes, sometimes deliberate, I suspect, on the part of paid preparers, is to put the entire registration fee for vehicles in as personal property taxes. Only the VLF portion of registration fees is deductible. Going down to interest you paid, we've got a very large interest payment on mortgage. Got some mortgage insurance premiums. This is worth noting because if the equity in the home exceeds 80% of the value, the homeowner is no longer required, in most cases, to pay mortgage insurance premiums. So that's something you might want to ask the taxpayer about. So gifts by cash and check, $2,750. We're going to put that into Schedule A, and $600 of that will probably flow to the 1040 on line 12B, I believe. So there's your total itemized deductions of $45,000. I'll note that if the taxpayer and the spouse had owned their home free and clear, no mortgage, this $18,366 would be gone, as well as insurance premiums. And that $18,744 makes it a huge difference. If that weren't there, then the taxpayer and spouse would not be itemizing on the federal return. They have enough to easily exceed the $9,000 or so of itemization threshold standard deduction on a California return, so they would still be itemizing on a California return. But again, except for this mortgage, they wouldn't have enough to make it worth itemizing. And that is pretty common. There's really only typically two reasons why people itemize. One of them is mortgage, have enough to itemize. One is mortgage, and the other tends to be high medical expenses. So one last thing of interest, we talked about a capital loss carry forward. And if we go to Schedule D, scroll down here, we're going to see that there was a loss in 2020 of $4,083. $3,000 was used on the tax return, and that leaves, they'll do the math for you, that leaves $1,083 to be carried forward into 2021. You'll occasionally see a taxpayer with a huge capital loss carry forward, tens of thousands of dollars that they've been working off, $3,000 a year. They had a very bad year some time ago, and that may have been when they got out of the stock market entirely, so they have no offsetting gains for those losses in subsequent years. The unfortunate thing is a lot of them have retired, and the $3,000 of offsetting losses actually doesn't help them at all in their tax return. So they'll just keep using $3,000 a year until it's done. So let's take a look at the intake booklet. The first thing you want to do is do a quick scan for any yeses here, because those usually have some impact. I don't see any of those. And then we have a dependent, as we did in 2020, and we'll need to fill out answer those 5 questions in the shaded area using information from the interview. On page 2, we note the taxpayer said they had some interest dividends. That matches last year's tax return. Refund of state local income taxes, as we mentioned earlier, that has the potential for being taxed, so we're going to have to look more closely at that document. Income or loss from the sale or stock exchange. That's not surprising since there was some activity in 2020. But if you look through the tax forms, you're not going to find any sale of stocks. So this answer is actually wrong and should be changed to no. Some retirement or interim pension, we know about that from last year. Social Security, of course, is a continuation. They've checked this box here, any of the following. Those are all part of the itemization process. Down here, the taxpayer said was not sure whether there was a capital loss carry forward. We know the answer to that is yes. So you should change the intake booklet to yes, mark that change. And receive an economic impact payment. That's not unusual, but even if the answer were no, we would still be asking the taxpayer to confirm that. Let's take a look at the interview notes. Since Debbie's mother, Vanita, provides none of her own support. We're in position now to answer those 5 questions in the shaded area of page 1 of the intake booklet. Let's go there for a second. So, is Vanita a qualifying child relative of any other person? No. She did not provide more than half her support. No. She did have less than $4,300 of income, the threshold. The taxpayers did provide more than half of her support, and the taxpayers did provide more than half, pay for more than half of maintaining the home. So there's lots of information about expenses that could be claimed on the itemize. When you're itemizing, we'll get back immediately after we enter the mortgage interest statement into the itemized section in TaxLayer. Let's take a look at how Vanita was entered as a dependent in TaxLayer. So notice it doesn't matter whether her first or last name are the same case or not. TaxLayer is going to print everything in capital letters. Here's an interesting question. Was this individual U.S. citizen? We know the answer is no. U.S. national, so there would have been a different sort of documentation, or U.S. resident alien. Well, she's not a U.S. citizen, so that makes her an alien. The resident part means she lived in the United States, I think for more than half the year, but in this case she lived there for 12 months. So she is a resident alien. We answer yes. There's a relationship, parent 12 months, and then a bunch of things to check, none of which apply to Vanita, and so we're done with that. What tax benefits does Vanita bring to her daughter and son-in-law? So let's do the QCQR tool. You can, of course, simply let TaxLayer sort of figure this out, but you really want to know what to expect. So if there's something different than what you expect, you'll either learn something from that, or you'll fix a problem in TaxLayer. Something should have been entered differently. So let's start here. Was the child, and again, child doesn't mean somebody under the age of 18. It simply means somebody's going to be a potentially qualifying child. So was the person of interest Vanita, a U.S. citizen, national resident alien? We talked about that, yes. Was Vanita son, daughter, stepchild, eligible foster child, daughter, sister, half-sister, stepbrother, or descendant? No. This person is not your qualifying child. See Chart 2. So now the question is Vanita a qualifying relative, and if so, for what tax benefits? Was Vanita the qualifying child? No. Was Vanita child, stepchild, brother, and stepfather, mother, or ancestor? So the answer is yes. Did the taxpayer and spouse provide over half of Vanita's support? Yes. Did Vanita have gross income less than the threshold? Vanita had no income, so she's under the threshold of $4,300. So the answer is yes. Can the taxpayer or spouse be claimed as a dependent on any other taxpayer's return? No. Did Vanita file married filing joint? No, she's single. So we go to page 5, box 22 here. Except for temporary absences, did Vanita live with the taxpayer and spouse more than half the year? Yes. Okay. So Vanita is a qualifying relative for head of household, which is irrelevant. Married filing jointly is not only a better filing status, it's the only one you can use. Credit for other dependents, that's at $500. Education credits, if Vanita had gone to college, there might have been some education credits. That wasn't the case here. Medical expense deduction, so medical expenses of Vanita can be claimed for itemization purposes. And child and dependent care credit. If Vanita were severely disabled and the taxpayer and spouse both worked, you could take child and dependent care credit. That's not the case here also. So basically what we're expecting is the $500, and we know that we can enter medical expenses related to Vanita into the itemization, Schedule A. Let's turn to the tax documents. The SSA 1099 for Devi has nothing particularly unusual on it. The SSA 1099 for Rupa similarly has nothing unusual. Make sure you don't miss box 6, income tax withheld. The 1099-R here from OMB has a taxable amount in box 2A, so we don't have to calculate it. That's nice. There's your federal tax withheld. So this couple is basically covering their federal income tax from one source, which is fine. Here's a mortgage interest statement. We're going to come back to this because the next thing to do actually is itemization. Here is a refund, which we talked about the taxability of. In this case, it's not taxable because in 2020, the taxpayers used sales tax, general sales tax for on line 5A instead of state income tax paid. So the fact that they overpaid them did not help them on itemization, did not provide any benefit to them, and therefore this is not taxable. And here's a 1099 div and a 1099 INT. Nothing particularly interesting. You've handled those before. So it's time to turn our attention to itemized deductions. We've put this off to last because sometimes you don't need to do this at all. If you look at the taxpayers' federal and state returns and you see that they owe no taxes, then there's no point in itemizing. The standard deduction takes care of wiping out all their taxable income, and they owe no taxes. And once you get to zero, you can't get any lower. So in that case, you can give them the good news that you're not going to need to do itemized deduction entries. However, in this case, Eswaras have a significant income, and so they do owe taxes, and itemization is going to help them. So let's start the process. If we go to deductions and then itemized deductions, mortgage interest and expenses is here. And before we click on mortgage interest reported on Form 1098, let's discuss the other one, a couple of the other interesting ones here. Mortgage interest not reported on 1098 is unusual, but if someone lends somebody money, a person-to-person loan, a mortgage, then although the person paying the mortgage interest can report it, the person who's receiving it does not create a 1098 because they're not in the business of lending money. Points not reported on a 1098 involve the payment at the beginning of a mortgage of points to reduce the interest rate. Let's say $3,000 for a 30-year loan in order to drop the interest rate by 0.25%. That $3,000 cannot be deducted in its entirety in the first year of the mortgage. It has to be spread across all 30 years. So each year, the taxpayer is entitled to report $100 of points. Now, if they pay off that loan, they can record all of the rest of the points that haven't been taken. So here's a case where you clearly want to put a note in the tax return that says, an electronic note in TaxSlayer that says that this person is, say, taking $100 of points every year because on such and such year they have paid $3,000 in points. And then private mortgage insurance we'll get to in a little bit. So this is an oddity. You get to mortgage interest and you expect to be able to enter something, but in fact you can't. You have to click yet one more time, but you can put in real estate taxes, whether those are shown on the 1098 from the mortgage company or whether they are reported separately. So we'll click on Edit Interest and Points. And here we are, simple entry. Again, a warning. The 1098, the first year of the mortgage, may show all the points paid, the $3,000 in the hypothetical example we were talking about. Do not put that in here. You are not just doing data entry. You need to treat those points correctly. So what else can be claimed as a itemized deduction? Health insurance for Veneta, we talked about that. That's claimable. Dental insurance, yes. Medical copays, yes. Dental copays, yes. Prescription copays, yes. Herbal supplements, no. Hearing aids, yes. And this is very common to see large expenses for hearing aids. Prescription glasses, yes. Physical therapy copays, yes. Spa membership, no. Miles, this is very common to forget to ask the taxpayer how many miles they drove to and from medical and dental appointments, going to pick up prescriptions. They're not reimbursed at a very high mileage rate, but every little bit can help. Vehicle license fees on 2 cars. You can't claim the entire vehicle registration. You can only claim the VLF portion of that. And gifts to charity. So we've got $100 of goods given to Goodwill. That goes under a different place than cash. And a $2,500 check to Sri Pamchamuka Hanuman Temple. Probably mispronounced. And that probably merits looking up online. You're not going to do this for very many organizations. They're going to be fairly obvious, the Boy Scouts, Episcopalian Church, whatever. But sometimes you run across something and you wonder, is this authorized charity? Because charities must register with the IRS, get a charitable number. So the IRS, if you look up IRS charitable organizations, you're going to see this page. And you click on this tax-exempt organization search tools, which is really a pain because that's not obvious. And you go here and you search for an organization. And we're going to search the database by organization name. And we know it's in California. Well, we don't know it's in California, but we suspect it's California. And we're going to enter the name and do a search. And scroll down, and yes, there it is. So we now know which expenses are allowable as deductions. Let's see where they go in TaxSlayer. The most complicated thing, at least in terms of time, to enter is medical and dental expense. In dental insurance, we had $8,000 and $1,300. The total gets put up there, $93. So notice that Medicare premiums entered on Social Security, the SSA 1099s, are not re-entered here. The amount paid to doctors and dentists, that's a total of 2 figures. Copays for prescriptions. Notice down here, this is grayed out. What that means is that this box has been used to enter individual costs. This is helpful because you now know what the totals were. It's also helpful if you've got 3 or 4 things to let TaxSlayer add them up for you rather than you doing it yourself. So that's our total for similarly other medical expense. There's only one item here, physical therapy, but it gives you some background information in case you're wondering what that is. So let's take a look at taxes you pay. So for taxes paid, you can either use state income taxes paid, the Eswaras have no state income tax paid, or you can use general sales tax paid, but you have to check the box here that says I want to use sales tax rather than income tax. And then you have to click here. So here's the sales tax deduction. You put in the zip code, you put in the number of days. You can override this if, in theory, the taxpayer has totaled up all of their receipts. No one ever does. You don't want to enter these numbers here. The system knows what the percentages are and you don't, and it gets awkward if you flip those two. This part is definitely worth paying attention to. In addition to the normal calculation, if the taxpayer has purchased a large item, and basically a car or boat, they can add the sales tax from that. And this is not trivial. If you have a $30,000 car and you paid 9% sales tax, you're looking at $2,700 deduction. And if you're in the 12% marginal tax bracket, that's worth about $300. So if you forget to ask somebody if they bought a car, and they in fact had, you may have just cost them $300. So do ask. So back to taxes paid. We've edited the sales tax worksheet. You had the option of paying less than 365 days if the person lived in multiple places. The state sales tax, this is basically designed to reduce the amount of sales tax credited, because if you pay in January, that's actually the subsequent tax year. If the taxpayer paid in January of 2022, this is wrong. This hasn't been updated yet. If they paid after December 31st, 2020, then that doesn't count for the state income tax, which we're ignoring anyway. So the vehicle license fees here, $119. Hopefully the taxpayer brings in the vehicle registration printout, which shows the VLF very clearly. Modified AGI. If there is something that the tax layer is unaware of, for example, veterans benefits or SSI, you can add that into the modified AGI. And that's important because if you're using the general sales tax, it's based on, the calculation is based on your income. And so you want this to be as large as possible. So another complicated, or at least a little potentially lengthy item is charity. Let's go into charity. And we've talked about this before. Cash gifts to charity are actually by check or credit card. Non-cash gifts are stuff. Let's go take a look at the stuff. And I note that charitable miles can also be recorded here. So it's fairly rare for our clients, I think that's true, it's fairly rare for our clients to volunteer to work at a charity like Tax-Aide. But if they do, they are entitled to a deduction for miles they drive to and from the charity. So if you have a suspicion that somebody actually volunteers, it's worth asking about that. So here's the $100 donation of stuff. Under cash gifts to charity, under cash gifts from stuff, you can enter them individually, as this was done, and that makes sense with a single charitable contribution. Most people, however, don't have a single contribution. So let's see what happens, what our alternatives are. So under cash gifts to charity, you have the option of doing an override and simply entering a total. Now, why would you do that rather than putting in the individual ones? Well, one thing is the IRS doesn't care. And the second thing is you really want the taxpayer to give you a total. You don't want to be sitting there totaling things up, and you don't want to be doing a lot of data entry where you're leaving the totaling to tax layer. So my inclination personally is to always use the override, but you do have the option, if you want to, of putting in a charitable name. You don't need a description. You need a date of donation. That's part of the irritation. Note that's mandatory, so we'll just put in a date of donation. Doesn't matter. And there's our $2,500. And that's it for itemization. We've done some medical and dental. We've done some mortgage interest and expenses, points. We put some taxes in, both real estate and vehicle license fees. And we put in some gifts to charity. This completes the court case for Eswara. Please pause the video until you have done tasks 5 through 7 involving the expanded case. All right, let's take a look at some interesting aspects of the expanded case. When you deal with a 1099-R, the first thing you want to look at is box 7, the distribution code or codes. Could be 2 of them back to back. And if it's anything other than 7 or maybe 3, which involves a death benefit, You need to look it up, figure out what it is, determine if there's anything that requires special handling. Basically need to understand what it is. In this case, this is a rollover. The money was moved from one custodian, a retirement account money was moved from one custodian to another. Federal Thrift Savings is the one that gave it up. This doesn't show who got it. So this is not taxable because it's simply being moved from one place to another. Taxpayer isn't taking any money out of the retirement account. That's why box 2A is blank. Of course, when you put in $4,000 in box 1, TaxSlayer automatically fills 2A with the same amount. You need to erase that so it matches the paper return. Another thing you need to do, if you scroll on down here, is you need to check the box that the distribution was rolled over, and you need to enter the rollover amount. It's not clear that whether, if you didn't do this for a G code, that there would be any problems, but sometimes money is taken out and the payer doesn't know what's going to happen to it, and in fact the taxpayer is going to deposit the check into another IRA or similar account. As long as they do it within 60 days, that's a rollover. It's code 7 in box 7, and the payer would think that it was taxable. You would want to zero out the taxability and make sure that you identify it as a rollover. That's the only way you're going to make sure the IRS doesn't come back to the taxpayer and say, why didn't you report this as income? For the W-2G, we've seen this something very similar before. So the only thing that you need to do, be absolutely sure, besides putting in the regular information, is make sure you enter the gambling losses. For this taxpayer, they're going to be able to use that to reduce their taxable income because they are itemizing. That information will flow automatically into Schedule A. You don't need to do any data entry for it. And if we go to the deductions page and click on the print option here to see Schedule A, we will see in line 16 other itemized deductions, gambling losses to the amount $112.50 entered by TaxSlayer automatically. You've seen 1099-Bs through a broker statement before. The only difference here, something that's new, is wash sales. A wash sale is where a taxpayer sells a stock or a bond or a mutual fund at a loss and then buys that same stock, bond, or fund within 30 days, either before or after, to basically recreate the position before the sale. And so the IRS says, no, you cannot take that loss because you essentially didn't really get rid of the stock or bond or fund. So what does that look like in TaxSlayer? And before we do that, note that we're not even giving you the detailed transactions here because this sale of stocks should be reported in a summary line, which you see on this page. In TaxSlayer, we've selected the alternate date, alternate option. This is various long-term. For the date sold, it's better to use the alternative option and code M for multiple reporting so that you don't have to guess what the date was. So the only other thing here is that we need to check W for non-deductible loss and put the $1,200 for the wash sale in. This concludes the expanded case. Let's look at some what-if questions. Question 1. What if the Eswara's property tax was not included on their mortgage interest statement and they did not bring their 2021 property tax bills with them, nor their vehicle registration renewal forms? Is there a way to get that information, that is the property taxes paid and the vehicle license fee information, without sending them home to find documentation? And so we wouldn't ask this question if the answer were no, they have to go home and getting the documentation. That's pretty uninteresting. So let's go and take a look for the first of these two questions about property taxes at the duck book, because property taxes and California vehicle license fees are both California specific. You're not going to find any help in the Pub 4012. The DuckBook lists 2 websites which are starting points for finding property tax information. Let's take the second one that's recommended. That's a list of county assessors. And if you go down to Contra Costa County, there's Gus Kramer. Seems odd to click on a person's name, but that will actually get you to the Contra Costa County property tax. So let's click on Gus's name. Here's Gus, but more important, if we scroll down, here's View Your Tax Bill. We click on that, and here's our lookup page. So the address for the Eswaras is 1025 Wilder Avenue. So the address for the Eswaras is 1025 Wilder Road. We want to search by property address. And let's just put in the first part of that and see what happens. We need to pick a city. That's Walnut Creek. The user interface will vary depending on the county, but this seems fairly typical. We click on Go, and we actually don't have 1025 Wilder Avenue because that's something we made up. So let's just pick one of these and see what we have. So it wants us to click here. And it shows the 2021-2022 tax bill. The taxpayers could have paid the April 11th, 2022 second half of the tax bill in 2021 and therefore claimed a deduction for both halves of this 2021-2022 tax bill. But they chose not to, so they get to claim $4,910 on their 2021 tax return, but not the second half. So what did they do with the 2020-2021 tax bill? So we click on tax history. We can see that oddly enough, they have chosen to list the tax years paid by the oldest first. What we want is 2021, and so that's this year. So let's view the bill. And if we scroll down, we can see that the second installment was paid on April 7th, 2021, so that could be used for itemization for 2021. And continuing down, the first half was paid back in 2020. That's not a surprise, can't be used for 2021. Now, in theory, if they had paid late and paid a hefty delinquent assessment, delinquent penalty, then this could have been used in 2021 as well. So again, the format is going to look different depending on which county you look up, but the point is that you know exactly when the taxpayer paid the first half and the second half of their property taxes, and you're interested in, for 2021, you're interested in the second half of the 2021 tax year, and you're interested in both halves of the 2021-2022 year because the taxpayer has the option of paying the second half early, bringing it up from 2022 to 2021. So there could be just one payment, typically, assuming no delinquent payments. There could be one payment during a tax year, or there could be 3 payments during tax year. Most of the time you're going to run into 2. But you don't need to trust the taxpayer's word, and more importantly, if the taxpayer doesn't have property tax information, you can look it up online and make sure it's accurate. So the second half of the question was, how do we find the California VLF, the part of the registration fee, the vehicle license fee, because that's the only part that is taxable. So California has a really nice lookup function. If you go search on California DMV VLF, you're going to see that first result here. Let's go click on that. And you have to put in 2 things here. You need to put the license plate, and you need to put the last 5 digits of the vehicle information, vehicle identity number in. Those will come off of the registration card that everyone should carry around in their vehicle. So I put in the information for my vehicle. Notice it asks for the tax year. And we click on Calculate. And there we go. This doesn't show the entire registration fee paid. It just shows what's taxable, even includes a disclaimer that only the person who actually paid the fee is entitled to claim the VLF amount above. So this can actually be printed, but I don't know that there's much reason for doing that. Unfortunately, sometimes you're going to run into taxpayers who are itemizing, should take the VLF. They have a registration card in the vehicle they brought to the site, but they have 2 or 3 vehicles. It's okay to estimate what the VLF is. The more you do, the better you'll have a sense of this. Basically, if you've got a new car, you could pay a couple $100. If you've got an old car, this is one that it was bought in July of 2012. So at this time it was paid, it was 9 years old. You can see that the VLF fee can be pretty low. So you put in a number. You could look at last year's itemization if you don't have the information and say, okay, it's dropped by a little bit. Of course, you ask the taxpayer if they bought a new car between last year and this year. So as long as you're a little bit on the conservative side, don't worry whether you're off by $5 or $10. It isn't going to affect the taxes significantly. It's not going to make the taxpayer subject to an IRS audit. Question 2. What if the taxpayer established a home equity line of credit, and then made some withdrawals from that to pay for a vacation? And then they brought in a tax form, 1098, showing the interest charged on the home equity line of credit. How would this affect their mortgage interest deduction? This used to be an easy question. It used to be that the taxpayer could have up to $100,000 of home equity debt, that is, debt that wasn't related to either purchasing or improving the property, and still take a deduction, an interest deduction on that. But the law was changed at the end of 2017, and for tax years 2018 and beyond, that includes 2021, the federal government does not recognize home equity debt as providing any interest deduction, whereas California still does. So we have nonconformance here. So the bottom line is, rather than going through all of the ifs, thens, and whats, is to basically say that if you have a mortgage interest statement, you need to determine if all of that is related to purchasing or improving the property. And to the extent it is not, you need to look at the Duck Book or Pub 4012 or other references, talk to an experienced counselor, figure out how much of the mortgage interest you can use as an itemized deduction, and that may very well be different for federal and state. Question 3. What if the foreign tax paid on Eswara's consolidated broker form, that is, on the 1099 div that was part of the consolidated broker form, was $890 rather than the $71.82? Well, the answer is that you can't just enter that information on the 1099 div anymore, because there is a restriction of either $300 for single or $600 married filing jointly to use the simplified method for the foreign tax deduction, foreign tax credit. And if you want to not use the simplified method, you have to fill out Form 1116, which is out of scope for us. The taxpayer has the choice of taking this $890 as a deduction. The problem is that the foreign tax credit, which starts on Schedule 3, Line 1, and flows to the 1040, is worth, each dollar of that is worth $1 of reduced taxes owed. Whereas if the foreign taxes paid go as a deduction on the itemized deduction, and some taxpayers aren't even itemizing, but in the Eswara's case they are, if it goes to Schedule A, it is worth only what the marginal tax rate is worth. That is, it reduces taxable income, and then taxable income is worth, a reduction in that is worth only what the marginal tax rate is. And the Eswaras are in the 12% marginal tax rate. So this foreign tax credit of foreign tax paid of $890, let's say 900, is worth 900 times 0.12, which is $108. So the impact on them is they are going to lose almost $800 by using Tax-Aide, which is unable to help them take full advantage of this. So the option at this point is basically to tell the Eswaras, you may want to go to a paid tax preparer. As long as you pay them less than $800, you're going to come out ahead. Fortunately, this doesn't happen very often. I think the takeaway should be that if you see a number larger than the $600 or $300 if it's single, that we're allowed to use, or we're allowed to process as a credit, you need to get the local coordinator or an experienced counselor involved in talking to the taxpayer about what their options are. This concludes case number 5, Eswara. You are now ready for case number 6.